Forgot to record from the beginning of the session. Man. It's okay. All right. All right. So with what we have, the first thing, let's link our drawdown. Let's link our new debt drawdown. So equal to, just link that to our what? Our new debt inflow. Copy that across the forecast period. Copy that across the forecast period. Copy that across the forecast period. So link your new debt drawdown. Link it. All right. You've linked that. Okay, so now let's calculate for our interest during repayment. So let's also link that to our interest rate. Let's link that to our interest rate. And remember to multiply by 1 divided by month a year. So link your interest, also link it to interest during repayments. And to avoid the circularity, we're going to do equal to, open my bracket, my beginning balance plus my new debt drawdown, close the bracket, and multiply by the what? Multiply by the interest rate. I can copy that across for the forecast period. So this is the reason why they don't usually get the whole funding that you need from the start. So it's based on your spend profile, and that's the way you need to draw down those debts so that you don't start accruing unnecessary debt, unnecessary interest expense from period one. Drag that across. Okay. So for the one that we have, the schedule we have below it, the beginning balance, the new debt drop down equal to, I also link that to my debt drawdown, link that to the new debt inflow. So the same thing you did. Right, so let me give us time. So calculate your interest during repayment. All right. Then the one we have below here, so beginning balance, new debt drop down, and this ending balance. So let's include one. Let's include one row here and call this one. Let's call this one interest accrued. Let's also call this interest accrued. Let's call this interest accrued. Let's call this interest accrued. And you do the same calculation for the interest during construction, beginning balance plus my new debt. Okay. Then multiply by what? Multiply by the interest expense, the interest rate. So remember to add this interest approach to your ending balance formula. All right, please, I hope you are still together. If you have any question, ask. So insert a row here. So beginning balance, new debt drawdown, interest accrued. Then we have the ending balance. And I said you should update your formula so that it becomes beginning balance plus new debt drawdown plus your interest accrued. So remember to copy the formula across. Then go ahead and do your interest calculation, which will be the beginning balance plus the new debt drawdown multiplied by the interest done in construction. Enter, and also drag that across. Okay, drag that across. Now we need our flag. We need our flag, which will be for construction, our grace period, our grace moratorium period. So here I'm going to call this construction. Let's call this one moratorium flag. Okay, and I will link this to our moratorium month, which is, I think we have 8 months here. 8 months. Okay, we can now use our flag. So equal to my period up here. Are you greater than or equal to our moratorium period, which we can put in the brackets and multiply by 1. So is it supposed to be greater or less? I think it's supposed to be the other one. So equal to my period, which I've listed, month 1 up to month 60. It should be, are you lesser than or equal to our moratorium period, which I'm going to log the column, put both of them in brackets. Now multiply by 1. Drag that across. So which means we expect to see 1, 1, 1, 1, 1, 2, 2, 2 over 8 months. Over 8 months. So I think what we should do is let's keep our grace period to the exact construction period, which is 7, right? So let's go to our input. That's our input. Let's update this our grace period. So let's just put a formula there instead of coding it. Let's make it the same thing as our setup period. So equal to, just add my construction period, my setup date plus my delay period, so that gives me 7 months. It's always good you match them together. So the grace period should now be 7. Right? Okay, so I believe we are good. Now, this interest done in construction that I've completed here, I'll put everything in brackets, and this time now multiply by what? Multiply by my moratorium flag. Multiply by the moratorium flag so that the interest is not calculated. The interest during construction is not calculated after our moratorium period. I hope you see that. I hope you see that. So that will restrict it. Now, let me also create a flag below it. For the second flag will now be repayment flag, right? And I also link that. So for the repayment flag, I will link that to my what? To my repayment period. Link that to my repayment period, which is 41. So this will be our repayment flag. So now let's create our flag for the repayment period. You can see our debt is very, it's a very interesting concept when it comes to project finance, even in corporate finance too. It's a very, very interesting concept. All right. So please, are we together? I hope we are good. So now for the repayment flag, we are going to need two conditional statements. So the first one will be one, this our period here should be above our moratorium flag, right? And also the date should be lesser than what? Our moratorium flag plus our repayment period. That is what I'm saying is, so which means from here, it will start counting from 1, right? 1 up to when we get to month 48. Month 48. Because the moratorium period is also included in the total loan period. All right. So to do that, equal to put my AND function. So the first thing is my period up here should be greater than our moratorium period, which I'm going to keep the column constant, comma, right? So the first thing is the month up should be greater than the moratorium period. And then the month up here should also be lesser than or equal to, I'll need to open a bracket, that will now be my what? That will be my moratorium period plus my repayment period. Close the bracket 2 times and press enter so I can multiply it by 1. So let me do that again. So equal to AND function, the period here, which I have the month 1, month 2, right? Number 1, it should be greater than my moratorium period, which is after the moratorium period, it should start counting, comma, then the period I have, this is my month list, should be lesser than or equal to what? Open my bracket, my moratorium period, which I'm going to keep the column constant, plus my repayment period, which I'm also going to keep the constant column, keep the column constant, close the bracket 2 times, and multiply by 1. And I can drag it across the forecast period. So if I look through, so from month 8, it will start counting to give me 1 up to what? Up to month 48. Up to month 48. Right? So you can see the usefulness of the timing flag. So this will help us to restrict so many line items. All right? Are we good? Any question? All right. So before we go ahead with and use the repayment flag, so please don't, as I said, don't memorize the formula. It's what you want, what we want to achieve. That should be the main thing that you should understand. Don't understand formula, don't cram formula. It's what we want to achieve. You should know how to do time and flags by now. The first thing is AND function, check the first condition. My list of months, are you greater than my moratorium period? Remember to lock the column of your moratorium period, comma. Then the second condition will be the list of my months. Are you lesser than or equal to, open your brackets, my moratorium period, lock the column, plus my repayment period, lock the column, close the brackets 2 times and multiply it by 1 and drag that across. Okay, so now let's go back to our So to any interest is just beginning balance plus the new drawdown multiplied by your interest rate, which you've converted to months, and multiply that by your moratorium period. So that everything stops in month 7. Okay, so for that's our schedule as well. Let's come to the ending balance. That's formula that we put here. Okay, no, don't let's do that. So let's apply it to the beginning balance. So the beginning balance, which is the closing balance for previous period, also multiply by the what? Multiply by the moratorium flag. That's in the second schedule, not the first one. In the second schedule. So press enter. So multiply the beginning balance, multiply by the moratorium flag so that it does not expand beyond. Okay, seems my Excel is hanging. What's happening? So it can be funny at times. Sorry guys, my Excel is hanging. What's happening? So please, if you are still struggling with cell referencing, please, those are they are the basic of basic Excel, right? You can go online, spend few hours on YouTube, search for cell referencing in Excel and be able to understand it very well. I think I also have a video on it as well. Guys, my Excel, okay, is it back? Excel is hanging. So let me just save it. Let me try and close it. So guys, my Excel is hanging. What I've done is saved because I'm not saving this version. Saving this version online. Okay, so good. So go to your beginning balance. Let's multiply the beginning balance by the moratorium period and copy it across so that it's stop. Everything stop in month 7, right? And also go ahead and link your interest accrued. Link it to the interest that you've calculated below. Also copy that across. Copy that across. For you to be sure. So here you can do the total under your new debt drawdown. Sum the entire row. Sum the entire interest accrued. Also sum it below so that we're sure this is what we are getting. So below here, I can do the summation, new drop down plus my interest accrued. And that will give us our new debt. So in simple terms, it means the business is collecting 1.6, I think that should be $1.6 million. And because of the construction period, the grace period, so they are telling you, yes, don't pay the interest, but calculate it. But you need to calculate the interest expense and accrue it and add it to the initial debt that you are paying. And you can see if you take a look at how we've calculated this interest during construction, you have your debt. So we believe we are using more like after a month after. So which means if you take a debt this month, you start repaying back the next month. So that's the concept we have here. So beginning balance plus the new debt, which means we calculated this interest expense. Now, because we are not paying it, we are going to add it back to our debt, and that will give us the new total debt balance, right? Which moves straight into the next one. Now, by the time we want to calculate the interest in the next month, we are also going to calculate it based on this initial debt we've taken with the addition of the interest that was accrued that we calculated and we did not pay. which gives us a new debt balance. Yeah, what's your question? You can type in the chat box. Then in year 2, you have your new debt, your debt that you've carried forward, which is your Kazim. Please, I really need you to always listen. I thought I said it more than 3 times, right? Please, can someone help me respond to Kazim? The reason why we are creating 2 schedule. I kept on repeating because I know this is a question that you guys will still ask. So the following period, we have the new debt that is coming, right? We are going to calculate interest on both the beginning balance, which means the initial debts that we took previous period, plus the interest that we calculated and we did not pay, right? We also add that in order to now calculate a new debt, and that's how you keep calculating it over the grace moratorium period. And that gives us additional cost, which is that interest that was accrued that we did not pay, and that gives us our new debt. Okay, does that make sense? Now let's now go back to the main debt schedule. So maybe we can put header there so that so this is the debt. So this is the debt schedule, right? Debt schedule. So this is the debt schedule. Then the other schedule that we created is based on. So this will be. I think we should call this one accrued interest schedule. Accrued interest schedule. As I said, the reason why we've separated it. One is it's easy for someone to also understand and to also avoid circularity. All right. So for our interest accrued, since we've calculated our interest accrued, right? Link your interest accrued, the one calculated under the interest accrued schedule, link it straight to the main debt schedule. Link it. And by the time you look at our balance in month 8, it should be the same thing with the total debt, which is the initial debt taken plus the accrued interest. All right. Link your interest accrued, link it to the main debt schedule. All right. Now, before we go to our repayment, so you can do the summation by the total column as well, so that will show sum the entire column together. It should give us 161, 661. And for our interest during repayment, remember, we can only start the interest repayment during the repayment period. So the interest during construction that we've calculated. Now try to put everything in bracket and also multiply it by what? Multiply it by our repayment. Multiply by our repayment flag. Multiply by the repayment flag. Multiply that by the repayment flag. I think we can delete the interest during construction that we put below. Now, one of the reasons why we usually have circularity, right, is when we calculate our interest during construction. So if you go to this accrued interest schedule, we are using beginning balance plus the new debt drawdown. typically, in practice, what we usually use is average of the previous period ending balance and the current period ending balance. So if you are using that approach, definitely to give rise to what we call circular reference. But for now, let's leave it the way we have it. All right. So the next thing is to calculate our principal repayment. Principal repayment. So can anyone help us with the principal repayments? Which formula can we use? How can we sort that? The principal repayment. So which means our new debt repayment will now be this 1661. So let me see. Let me try this method if it will work. So let me check this if this will work. What's the way we want it? So let me check if this method will work. If it give us what we need. So there are, especially when it comes to this kind of monthly model, we can use PMT, PPMT, and some other method. But let me check this. I think this should be more like a simpler method. Don't do it yet. So let me look if this suits what we have here. Okay, check this. Okay, sure this method will work. So sorry guys, I'm just trying to look at the best one that we can use. If you know of any method too, I think that will work. I'm trying to see the one that will not scatter the class. Okay, all right. So let's use PMT. Okay, all right. So let's calculate our interest expense. Let's calculate our interest expense. So I know we have PPMT. I said you can check my YouTube video. I have a playlist of debts calculation. So now let's use PPMT. So you can come to this under this column of column H, then type equal to PMT. Let's use PMT. Let's use PMT. So PMT, the first thing is asking for is our rate. So select my rate, which is monthly rate, comma, the number of period of our over our repayment period, that is what? That is 41 months. Okay, comma, and my present value is now what? Is this my total debt, which is my initial drawdown plus the accrued debt 1661. Close your bracket and press enter. So you can put negative in front of it so that it returns it back as positive. Okay, so PMT is asking for what? PMT is asking for the interest rate, which is the monthly interest rate. Then the number of period, which is our repayment period, 41 months, comma, and the what? And the value, which is 1661. That is our debt drawdown plus our accrued interest. Press enter. All right. Now you come to our debt. Now, the value this PMT is giving us. So remember to put negative in front of it so that turn it back to positive. So this is inclusive of both the principal that we need to be paying and the interest, right? This 50, so which means over the repayment period, we're supposed to be paying 46,000 USD every month over the next 41 months, which we are repaying. And this 41 is inclusive of both our principal repayments and also our interest element. I think we use PPMT for the interest, the only principal, but I always prefer PMT. So which means since this 46 is inclusive of both our principal and interest, and we've already calculated our interest, what do you think we need to do? So which means we can deduct that interest that has been calculated already. We deduct it from this to give us the remaining principal repayment element. So that equal to, open my brackets, this my calculated both principal and interest, which I'm going to keep the column constant, minus my what? Minus my interest expense that we've already calculated. Close the bracket, right? And press, but I think just, okay. So then multiply by what? Multiply by our repayment flag. So multiply that by the repayment flag so that it starts calculating, starts repaying when the repayment starts. Press enter and you drag that across. Drag that across and take a look at what you have at the end of your repayment. At the end of your repayment. So let me see. I'm usually trying to put the main function. Let me see if the main function will work. See the main. Okay. All right. So I hope we have that. So now, one thing usually happens. So at the end of the repayment, due to rounding error in Excel, right, you usually have something like this. So this does not mean it's not fully repaid, but just because of those funny rounding error. Now, I know some people usually use main function to be able to add it up, right? But most times that main function, you also need to be very, very careful, especially if you have an outstanding debt. So what we do is we come in front of this, our formula that we've put in our principal repayment, okay, in front of it, and I'm going to type minimum, open my brackets, minimum, open the brackets, come to the end of my formula, comma, or the previous ending balance. The previous, so minimum of what you've calculated inside that cell already. Go to the head of the formula, put comma, and select the previous period ending balance. Then close your brackets and press enter. So if you drag that across, that will just help us to treat that rounding error and make sure everything is balanced and is fully repaid at the end of the period. So you come to your principal repayment. So if you do the summation, it will definitely be the same thing with the what? The initial debt that was drawn down plus the interest accrued that was calculated. You are getting circular. Okay. Wait, let me check my own. I'm not sure. Is anyone getting? I'm not. Then there's no way you should get circular reference. That's why we created this accrued interest. Is anyone getting circular reference as well? That's why that's why I said the reason why we separated this accrued schedule here. So look at your interest during construction. How did you calculate it? So I think you had so check. So your accrued interest is beginning balance plus new debt drawdown. So don't add the accrued interest to it. Also, the way we calculated our interest during construction, during repayment, is also beginning balance plus new debt. We did not include don't include the accrued in it. As I said, we assume it is more like a a a month. So we are assuming a end of the month debt drawdown. So which means if I'm taking a debt this month, so let's assume I want to access debt this month. So if I collect the debt this month, I'm not going to pay anything this month. My repayment to start in next month. Yeah, so it's not to get circular reference. So also check your principal repayments. You're not to have circular reference. That's why we separated as accrued schedule like this. As I said, yes, though in the typical transaction, they usually use the ending balance of the debt. So which means instead of us doing this beginning balance plus the drawdown, so what they would do in the typical the practice of a corporate world, right? What we usually do is we say it equal to average. It will be average of the current ending balance and previous period ending balance, which means you see that accrued interest that we've calculated. So which means we are saying we are taking the loan at the beginning of this month, and then our repayment is also starting at the beginning of that month. And the reason why that is so that by the time you get to when you want to start to repay, your repayment is starting in that same month. Okay, so that would take about most times we usually use the average multiplied by the what? Average multiplied by the interest expense. So and that's the reason why I said, you know what, let's build that out separately. So let's build that out separately so that to avoid something like that. Okay. Can you see which formula? We didn't use any formula. Which line item, please? Which formula? Formula for which line item? The principal repayment. So we just added the mean function to it, the mean, so that it helps us to restrict when it's the final repayment period. So we send this principal amount, which we've calculated there, which inclusive of both our principal repayment and the interest. So every debt you take has two elements. The principal, so the principal is actually as if you've taken 500 million, divide the 500 million by the period you want to repay back. That's the principal. Now the element which it becomes a gain for them to also be it against time value of money is the interest element. So by the time you are paying the principal plus that interest. So what this PMT has helped us get is this is the amount we'll be paying every month. So which means if you go to any of the month, if you sum both of them together, you see that they will give you 46. And if you see that it vary. So at the beginning so at the beginning, I think it's like the indirect slope or something like that. So which means at the start you pay lower interest, you pay lower principal and higher interest. Then towards the end, you pay higher principal and you pay lower interest. So which means those people too also want to make sure that they've collected the gain on their money as soon as possible before any other thing. Okay. So now with this, by the time we link it to our balance sheet will not balance. And do you know why? It's because we have this accrued interest guy. Because it has been accrued, it was not expensed. So which means this amount of accrued has actually increased our debt balance at that particular period. So which means the next thing we now need to do is to what? And by the time we are repaying it back. We now need to go and we now need to capitalize it and depreciate it. Right? So we need to be able to now what? We need to, so I'm going to call this. So let's call this our accrued. So to call this capitalized accrued interest. Okay, and that will be my beginning. So my beginning balance. Then I'm adding my what? That interest accrued. Then I'm deducting. So less interest. So less interest. Let's call it interest amortized or interest depreciated. Anyone, then ending balance. So we need to do what? We need to capitalize that interest. Okay, but before we do that, let's link our debt schedule first to the financial statement so that you will see that the balance that we'll be having will be what? Will be that accrued interest. So let's go ahead. First, my ending balance of my debts, I'm going to link that straight to my what? Go to my balance sheet, link the ending balance straight to my borrowing for each month. Ending balance of the debt schedule. Link that to your balance sheet. Okay, then come to your cash flow from financing under my debt inflow. I will also link the what? I will link the note, the new debt drawdown. I will link that, and below it, I will also link the what? I will link my principal repayment, which will be in negative. Which will be in negative, is a cash going out. Okay. And also the interest expense elements, I will also link that to my what? Interest expense in my income statement. Also remember to put that in negative. So interest expense, which is interest during the payment, please. So drag that. I'm still getting the circular error. Okay, I'm surprised why you are getting. Do you make sure you did you do this accrued interest schedule? Because I think looks like you had. Is anyone also getting circular reference, please? So now see this new debt. Look at this new debt drawdown under accrued interest schedule. You are linking it to the main source of funding. Don't link it to the new debt drawdown. Check that. Make sure that's not what you are doing. The new drawdown under our accrued interest schedule, we are linking it to the debt in our source of funding, not the drawdown under our debt schedule. Check that to be sure. Your ending balance for your accrued interest schedule, beginning balance plus new debt drawdown plus this. You are getting 46, but is your debt fully repaid at the end? Is your debt fully repaid at the end? I'm getting 46, and that's the 46. That's your principal repayment. Yeah, so sorry about that. Then your interest during construction should be your beginning balance plus the new debt drawdown in that interest accrued schedule, multiplied by your moratorium flag and multiplied by the interest during construction. Okay, copy across. Then for my in-depth schedule, beginning balance, closing balance for previous period, new debt drawdown should be linked straight to that what? Sources of funding directly. Interest accrued, link it to the one we calculated below. principal repayment. Then my ending balance should be my beginning balance plus new drawdown plus interest accrued minus my principal repayment. So that should give us that. I'm not sure why it's secular. Reference should come into play. So check. Okay, so link my interest expense. Link it. Remember to put it in negative, and also remember to update your formula, your profit before tax formula, because we are now using a what? A positive, a negative conversion. So in case I know that some people still prefer the positive, which is fine. So remember to update your profit before tax will now be what? Operating profit plus the interest expense. Now that the interest expense is in negative value. Okay, so check your model. No, your model will not balance now. And if you look at it, you see that it's almost 44. To go to your annual financial statement and also do the same thing. So you can copy the formula for your depreciation, put it under your interest expense. Remember to also update your profit before tax formula, change it to plus. Right? Then my borrowing, I can copy any of the formula, put it under my borrowings. Okay. Then come under my cash flow, copy any of the formula, put it under my debt inflow and also my principal repayments. I see that the balance check will be what? Will be 44, which is the accrued interest that we now need to capitalize. Right? So please do the monthly one. And make sure you copy the same formula, put it in your yearly one. So that's one of the reasons I really love doing monthly model. So in addition, when it comes to most project finance, the repayment is not usually monthly like what we've done. Now, most time it's always based on agreement. So it could be quarterly, it could be semi-annual, and it could be annually. So in case where you have that, so some of the options you can also use is you build them out monthly like this. Then you now try to consolidate it. But most times the most preferred approach is to, if they are paying quarterly, that means the payment is supposed to come quarterly basis. If they are paying semi-annual, it will be a 6-month interval like that. We can always explore that on your own. Okay. So your balance sheet should be showing 44, which is the accrued interest. Okay, so now let's go and treat the accrued interest. So we have capitalized accrued interest expense. Put my currency here. Put my schedule. So beginning balance equal to previous period ending balance. My ending balance is beginning balance plus my interest accrued, then minus my depreciated. Copy that to the right. So I'm going to link this straight to my interest accrued, which is the same thing as interest during construction. That should give me 44. Okay, then my depreciation. To calculate how I'm going to amortize, that would be equal to my total interest during construction, right? Which is the 44 divided by my what? Divided by my repayment period. So you also divide it by the repayment period, so that this kind of gives us the value. And you can put that under column H. So which means this 44, we want to depreciate it, we want to amortize it over the what? Over the same 41 months. All right. enter. And what I'll do is just equal to link that value and multiply by the what? By the repayment flag and copy it across. Let me do it again. The set beginning balance, your interest accrued. So make sure you link it to the completed one. So you can also do the summation. The summation by the total column. And under the amortized, so you should just do equal to the total interest accrued, then divided by what? Divided by my repayment flag, which is 41 month, enter. So that will give us what we need to be paying, what we need to amortize over the what? Over the repayment period. So type equal to that value, should keep the column constant, multiply by what? By my repayment flag, enter. I can drag it across for the period. And now we're also facing the same thing we faced while we created our repayment schedule, and we can now introduce the mean function. To introduce the mean function, mean of what we've completed and the previous period ending balance, that will help us, that will take care of the rounding balance. You can see now that it's getting interesting, right? Especially this debt funding. So as I said, most time, one of the reasons why we build a typical operational model aside for management strategies and plan, most times business want to get short-term debts, they want to get in a network working capital debt. So definitely they always want to see what's the expected business performance over this particular period. What is your expected net cash flow? How will that translate into cash, and what's the headroom and things like that. Okay. All right. Now let's link the accrued. Let's link that straight into our what? Into our balance sheet. Let's link that into our balance sheet. So now, if I come to my balance sheet, but we don't need to create another. We don't need to create another line item for the accrued expense, for the accrued interest that we are capitalizing. Just come to your PPE, click inside it and put plus, then plus the capitalized accrued interest ending balance. Right. So you don't need to create another line item for that. So plus, so it's going to link that. Just add that to your property, plant, and equipment. You don't need to create another line item for accrued interest. So link that, then you see from year 8, balance sheet will not balance. So which means just go ahead and go back to your depreciation. Let's go back to our depreciation, and inside our depreciation formula, where we have open a bracket minus assets plus one asset, then plus we now add the amortized amount, add it to it, and you copy that across. Which your model our model to balance now. Okay, yeah. So this is just a typical rounding error, right? So go to your cash flow. This is what you are going to see. Your balance sheet should be balanced, which might just show those bracket 0. Yeah, so tell me your model is not balanced, so it's just because of that accrued interest calculations and Excel rounding error. So most time what we usually do is we usually introduce what we call it a tolerance level, right? So that can help us take care of this, and we don't need to disturb ourselves. All right. Are we good? Are we good? Are we good? Are we good? So let's introduce something we call our tolerance level to this. Okay. So that we can take care of what we have. But before we do that, yes, let's come to our checks. So as I said, we usually have something we call a check, a check, a check, 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 check. So you have like a check, you have a check workbook. So here I'm going to call this our tolerance. So we call it tolerance level, right? And most I think usually use 0.01. So you can increase it to so 0.01. I come to my name manager. I can also name it as tolerance. Yeah, so just to take care of those funny rounding error. Because most time when you build a model with depth or it comes with accrued interest, you usually have something like that. So here I can come to my name box and call this tolerance. Call this tolerance. All right. So we call that tolerance. So go to your check for this tolerance to 0.01. You can increase it, but most times try as much as possible to keep it to the lowest decimal. Okay. Now let's come back to our monthly financial statement. Let's come back to our monthly financial statements. And now we are going to edit our check. We're going to edit our check. So here I'm going to type equal to if so ABS, which is absolute. Absolute. So this is very important. ABS absolute. ABS of what? Of my total assets minus my total equity and liabilities, close the bracket, is less than our tolerance, then it should give us 0. If not, it should give us 1. So equal to if we are updating our balance check. So if look your brackets, ABS, which is absolute of what? My total assets minus my total liabilities. If it's less than my tolerance level, which means as long as the difference is less than 0.01, it should give me 0. If not, it should give me 1. And I'll close my bracket, enter. I can drag that across the forecast period. So that just helps us. That will take charge of the whole rounding error. So I can copy the same formula and put it under my annual financial and copy that across. You can see that. So copy that across. Now what we now need to do is go back to our check. You see this monthly check. Right. So most time when we build our model, there's always more like something we call a mega check to be sure that yes, everything is working perfectly. So what you do is the annual FS balance check, link that under our annual period here. Now come here, link that straight. The one for monthly, okay, equal to go to my monthly and also link it here. Link it here. So you link it like this. So the annual FS, you link that under annual. The one for the monthly, you also link that for the monthly. And by the total, you just sum everything up under each of them. You also sum everything under annual. You sum it up. So maybe let's leave like 2 row and let's call this master check. We are still going to have some other checks. because the model is definitely prone to error. So there are so many checks that we usually we try to build into the model to be sure that we are not missing some things. For the master check, just come down here and type equal to sum everything from your monthly FS check, annual check, then including the two row that we added to it. So this becomes our master check, and below it we can now say so check check results. So for the check result, we just put equal to if my if our master check is equal to 0, comma, then open your double quotes. You can open your double quote and type your check, model check, your column, model check column, okay. Place your quotes. If not, model. If not, then open your double quote again. Model check, model check error. Close your quotes. So see, so equal to if my master check is equal to 0, then open your double quote, type your model check, column, okay, close you can put a space, close the quote, then if not, they should give us model check error. So that you have this and every other thing in the worksheet. So we can now rename that cell. We can rename it master check. Master check. Like that. And you can now go to each of the worksheets where we've typed this model check manually. We can now change it to the name. So model check. So master check. We change that to master check. So on all of your worksheets where we've typed model check manually, you just go there, type equal to master check on all of your worksheets. So just do for one, now you can copy it and paste it across. Go to all my worksheets and I'm copying that. So the master check is on all of the worksheets. So as I'm working, if anything is wrong, I'll automatically get the also put it in my menu page. Right. So that also helps you to keep tab of your model check. So at times we also have we used to have something we call, so you have two checks. One would be for the worksheet check, right? Then we now have like the master check. So which means each of your worksheets, you make sure you create different type of check so that you are not making mistake. You are sure everything is tally to what ought to. Okay. So also remember, if you go to your monthly financials under your total, try to be consistent. So I'll copy my total, copy everything. And so you can just copy that one across to do it. Okay, so we didn't create, so we only created total for the cash income statement. So I can also create the same thing for my cash flow. As I said, balance sheet does not need, you don't need total for your balance sheet. And for the cash flow, the need for beginning balance, just only the change. So just try to be consistent. Keep your format. You go to your HANA, you also do the same thing so that you are consistent. Consistent. So I'm sure by the time you are looking at what we have, the business is already telling a funny story already. I'm doing this, I'm filling up my total column. So from what we are seeing, it definitely looks as if the business is going to run into some funny thing. Because even cash is very difficult for the business to survive with the cash during this period. All right. All right. So are we good? Are we good? Are we good? I think the next thing we are left with is our tax and also our dividends before we complete our three financial statements. Right. And once we complete that, we can now start with we can now go straight into our analysis and also try to look at how we can also play with some of the assumptions to make sense. All right. So maybe that might even lead us to what we call scenario. Okay. So for the tax, I think we should keep the tax simple, right? I think we should keep the tax simple. But in case you want to learn more about how we deal with tax losses, tax relief, and all those things, I think you can learn that on your own. But at least for the purpose of our or what we have now, let's keep our tax simple as it needs to be, right? So we do it like that. Okay, you know what? So let's just quickly treat the tax before we call it a session. Should we do the tax now, or I should let you do that? Okay, I think that should be. I think let me allow you to do that. So just keep it simple. If our profit is positive, then we should calculate the tax. No. You to also do that as part of your. So let's do that. So calculate your interest expenses. Just keep it simple. Your profit before tax multiplied by your tax expense. Definitely, you know that if you are not making profits, you should not pay any. You should not pay any tax, right? And you know that. So that you know, please listen very well how to calculate your tax. One is, I think you can come back to your operation. So maybe you can put, where did we put our tax? Okay, yes. So tax is under operation. So we can come under your operation. Come under your operation. Okay. Come under your operation. So create the heading for tax. Like I said, let's just keep it simple. So 5. I'm going to call this tax expense. So 5.1 tax computation. So let's just use accounting. So accounting tax. Right? So first thing is you need your profit before tax. All right. So this will be monthly. This will be monthly. Okay. Then you now need your profit before tax on 12 month basis, because it is on your 12-month basis that you'll be paying your what you'll be paying your tax. So it's not as if you pay tax monthly, right? You pay it at the end of the year. Should we use at the yeah? So the end of the year is always good. So which means you need the profit before tax on straight 12 months. Then you need your profit before tax on 12-month basis. I think you can use offset. I also think there's like some use that you can use. Then you now calculate your tax. So your tax rate, I can calculate your tax based on that tax expense. So I'll also remember you pay that tax. So you pay that tax when profit before tax on annual basis is positive. So remember to include that in your calculations, right? And also for the dividends, maybe you can just leave the dividend as monthly as well. So I think you pay dividend at the end of the month. So which means the same concept you use for your tax, you definitely use the same thing for your what? For your dividend. So I will give you this as your own assignment against the next session next week. Right. So you too, it's part of your learning. Bring out your creativity. Let's see what we have. And I also share my own version with you. They said you can be wrong, you can be right. So we are all learning. Right. So once again, your task, put do the computation of your tax expense based on your own understanding. Yes. I said, firstly, your profit before tax on monthly basis. Then you now need to consolidate each of them. So month 1 to month 12, that's one tax calendar year, another month. So you do that on 12-month basis. You do that submission. Because on it, you now apply your annual tax rate on. And also remember, you pay tax when you make profit. So I said, let's keep it as accounting tax. Leave provision for losses. Well, you can also do that on your own. Then link that to your tax expense. Remember to update your net profit formula and to consolidate it into your annual financials. Okay. So at the end of the session, I will share this my own file. I will share it with everyone so that you can have access to it blockingly. We forgot to record the session from the start, so I guess I just need to pick it up from where from what we have. Right, right. So thank you everyone, and thank you for today. Uh, I hope it was an interesting and challenging one. Right. But we try to keep it as simple as we can. This is more of like an advanced modeling. Right. So thank you everyone. Thank you for your time. Please let's make sure we enjoy the rest of the weekend and be good. Okay, wait. I think let me wait, guys. So let me check if I can. Let me see if I can drop the file in the chat box. Let me see so that everyone can have access to this and I don't need to uh, spend time sending email. Also, just check my YouTube video for the recording. Right, I might not get an email from me. Okay, yes, okay, good. So I can send that. All right, so yeah. So I've dropped the model document in the chat box. So please access it. So download it. Make sure you download it. You don't need to. So just click on. You see the three dots. Yes, just download this straight like that. You don't need to. So don't. So you won't receive any email. And also, just look at go to my YouTube channel. I'll definitely be uploading the documents there, the video. Yeah. So as soon as we are done with this session, right? So yeah. So don't expect any email. Right. After this training, I'm going to another training till almost till 7. So access the file, download the file, or drop it in the chat box. So people that did not come, um, good luck to them. So download it from the file. I will drop the recording in the same downloading field. Please let me know. Anyone else, if you cannot access the Click on the three dots and click on download. Going down. Okay, second person. Please, guys, let me know in case you cannot download it. You also need to send it via email. Oh, same here. Oh, okay. So I think okay. All right. Guys, I won't. Okay. Seems I will end up sending it via email. Okay, all right, then that's fine. That's fine. All right. Okay. So thanks everyone. Please let's enjoy the rest of the day. And bye for now.